Are you ready to take control of your financial future? In this video, we'll show you step by step how to build a diversified investment portfolio that will help you reach your financial goals, from setting your investment strategy to selecting the right stocks, bonds, and mutual funds. So grab a notebook and let's get started. If you want to be a good investor, you will need to have a well-balanced portfolio. Otherwise, we are going to lose money.
The main mistake everybody makes when they start investing is that people invest the money they need to live. Then, when a bear market comes and it's time to buy, they tend to need that money and they tend to sell positions in the red.
That is the reason for our first little sector on this pie chart. The emergency fund. We must know that this saving will always depend on the amount of months that we need to be able to live without a job. It is recommendable to have between 6 and 12 months, it depends on how optimistic or pessimistic you are about finding a new job. Bonds market is often used to compensate inflation. It is not a good idea to have money sitting in the bank. Let's say you are planning to buy a property. Once you have your emergency fund, you can start to move the rest of your money to bonds, so you will be able to mitigate the inflation that plays against your savings. Just to be clear, bonds are not made to generate money, except of course for some risk-specific cases. Then we have the stock market, which, as you can see, is a large part of my portfolio. The stock market, as you already know, it's used to generate wealth. We put the money to work for us instead of being us working for the money. Finally, we have a pie section for liquidity. This liquidity is used to buy, at any time, any stock. It is vital to have this percentage always ready to be used, otherwise we will miss windows of opportunity, and we will have to wait for the next one or even worse, buy at a bad time that makes us lose money. There are also external factors such as currency exposure that can cause us to lose money. This concept is something that many beginner investors forget or do not take into account. What happens when we buy an asset in a currency that is not ours? What happens when that asset goes up, but the difference between currencies spreads? Let's imagine that we invest €100 in a stock, and this stock is in a foreign market. Let's say for example that it is a dollar market. The day we invest, the exchange rate is 1 to 1, in other words, €1 is equivalent to $1. After paying $100, this share is revalued and becomes worth $105. But when I close the position and liquidate the share for $105, the exchange rate between currencies is €1 to $1.06. So I am going to get €99.06. What happened? I thought I had $5 benefit. Well, what has happened is that you have suffered exposure to the currency. You were not protected against changes in your currencies, and you have lost money despite the stock went up. If we have bonds in our portfolio, we cannot forget the type of debt. Not all bonds are of the same quality, and this depends on the country from which we buy them. For example, a German AAA debt is not the same as a Spain A-, which is considered to be of medium quality. As I have mentioned before, bonds are great because of the low risk and the high reward. What would you say if I tell you that there is a stock that pays you a coupon of just over 4% for the next 2 years, and assures you that it will not go down in price? If it does, it maintains you at the original purchase price. That is the US government's 2-year bond, with a AAA rating as the world's largest issuer of debt in terms of credit quality. Morningstar, some time ago, unveiled a new way of visualizing sectors. Morningstar called them super sectors, and these have also a subdivision into sectors that we are all familiar with. We have the cyclicals, which are those that, depending on the period we are in, will go up and then go down again. They are always correlated with the economic cycle we are in. We also have the defensive ones, which are those that are more difficult to be affected by occasional bull markets. These also have a harder time going up. They are usually basic services, those that people still need to survive, even though we are in recession. Finally, we also have the sensitives. They are those companies that do not depend directly on the economic cycle in which we are, although they are affected. All this information must be taken into account if we want to design a portfolio that will withstand the economic cycles we will go through. And just to be clear, we will go through them. If you want to know more about super sectors, what they are and when to invest in them, don't worry, we will make a specific video talking about them. Another factor to take into account is the risk-return ratio. If we fall short in profitability, inflation will eat us, as for example happens with cash and some deposits. If we go too high in profitability, we will be assuming too high a risk. In the end, the important thing is not to assume high risks, but to know what percentage and how much of our portfolio we are willing to risk. Can we afford to lose €5,000, maybe €50,000? Maybe our risk tolerance, and I am not talking about our financial tolerance, is much lower or even zero. First, we will have to know ourselves, and then we will be able to invest correctly, because the biggest mistake we can make, and believe me, I have seen it many times, is to withdraw the money just when the market falls. Because then for sure you are going to have losses. Finally, and for me the most interesting of all, is to see how our portfolio would behave if we compare it to a market benchmark. For example, the S&P 500. Have we designed a portfolio that is doing better, or on the other hand, if we had put all our money instead of stocks in an ETF or any other financial product, it would have done better? I, for example, have compared my portfolio with the benchmark called SPY, and we see that the companies in which I am during that bearish year has had a better performance than the SPY. You may be wondering how to make this comparison between my portfolio and a benchmark index. Well, I have prepared a Google Sheet where you can edit your stocks and see the result. To use the spreadsheet, you only need to edit the period keeping the date format, then put the names of the stocks and the amount you have, and it tells you what I would have earned in comparison with the benchmark. Where it says benefits is the value having discounted the initial investment. Yes, those $3,600 are just profit. In other words, we would have almost doubled our initial investment. If you notice, our portfolio, during this period, operates almost identical to the market. I leave the link in the description.